When Insightful Value spots a logistics powerhouse trading near its lows, we have to dig deeper. Landstar System's stock price has been sliding, but is the market overlooking something important? This review is for informational and educational purposes only, not financial advice. If you enjoy this kind of no-fluff value investing content, hit that like button and subscribe for more. Let's get into it. Landstar System is a unique player in the freight transportation world. It's not your typical trucking company. They operate an asset-light business model, using a vast network of over 108,000 independent owner-operators, agents, and third-party capacity providers. That means they avoid the massive overhead that traditional logistics firms carry, allowing for impressive operating efficiency, even in weaker freight cycles. The company specializes in truckload transportation, including dry van, flatbed, refrigerated, and expedited services. They also offer rail, intermodal, and air freight solutions. But over 90% of their revenue comes from truck transportation, which makes them very tied to the broader U.S. shipping economy. Now, on the surface, things look rough. Revenue in 2024 has declined compared to the pandemic-fueled highs of 2021-2022, when demand for shipping was sky-high. Year over year, revenue dropped to about $5 billion from a peak of over $6 billion, and earnings per share followed suit. The stock is now trading at a forward PE well below its historical average, and that's catching the eye of value investors. Despite the downturn, Landstar still posts impressive margins for a logistics business. Their asset-light model helps them maintain an operating margin above 9% even in a weak cycle. Free cash flow remains solid, and the balance sheet is nearly debt-free, which gives them flexibility that many peers don't have. On the dividend side, the company pays a regular quarterly dividend, currently yielding just over 1%, and they've been growing it steadily over the past 10 years. They also regularly issue special dividends and conduct share buybacks when cash piles up. It's a shareholder-friendly business. So, what are the risks? The biggest one is cyclical exposure. Freight demand is highly sensitive to economic conditions. When shipping volume declines, like we've seen in 2023 and early 2024, revenue and profits take a hit. There's also competitive pressure from both traditional carriers and newer logistics tech platforms. But here's the contrarian angle. Freight cycles don't stay low forever. When volumes rebound, a lean operator like Landstar could scale faster and more profitably than others. With a clean balance sheet, operational flexibility, and a loyal network of independent drivers and agents, they're well positioned to weather the storm and thrive on the other side. At Insightful Value, we specialize in uncovering companies like Landstar, out of favor but not broken. We break down key data, cut through the noise, and present opportunities that make sense if you're focused on fundamentals. If you want deeper insights into this and other undervalued names, head over to insightfulvalue.com. Don't forget to subscribe to the channel and hit like if you got something out of this video. See you in the next one.